Craig, Devon, we're going to carry on our discussions today about retirement planning, and we're going to focus specifically on investing through retirement annuities. We know there's always been some negative sentiment with regards to investing through RAs and in local markets. Craig, what are your thoughts on this?
Look, I think the first thing one needs to bear in mind is that people often look for an excuse why not to invest, because the opposite of investing is spending. So if you just bear that backdrop in mind, there are a lot of convenient excuses. What we need to understand about retirement annuities, there were certain protections put in place post GFC, the Great Financial Crisis, to protect investors from being 100% exposed to equities, which are the most volatile asset class, but they do provide the best returns over time. So these restrictions, called Regulation 28, are often cited as the reason for not wanting to invest in a retirement annuity. Regulation 28 does, however, allow as much as 45% of your investment to be invested abroad. If one then adds to that the money invested on the local stock exchange, 65% more or less of those profits generated by the top 40 companies on the JSE are also generated abroad. So when you think about it, a retirement annuity actually has a massive amount of global exposure. So that's one of the sort of primary reasons people are given for not wanting to invest in a retirement annuity.
If we think back to 2020 when COVID happened, again, Craig mentioned that people look for an excuse not to invest, and again there were a lot of opportunists who took that period of time to advocate for exiting retirement annuities. Rand had weakened quite significantly over that period, and there were a lot of people saying we should disinvest out of the country and invest abroad. So it's interesting when you actually look at the numbers, what's actually happened since then. So just to use COVID as an example, back in May 2020, when markets crashed and Rand depreciated, Rand was trading at 17 Rand 50 to the dollar, and over the preceding 3 years, it's depreciated. We're now sitting at about 19 Rand. So it's an 8% depreciation, which is significant. And if you had cashed in, and let's ignore what it would have cost to exit all your RAs. If you had cashed in, bought dollars and invested offshore, and let's use the biggest offshore market like the S&P 500 as an example, it's grown 25% over 3 years. So those numbers sound great. Like you would have done okay if you had followed that negative sentiment of exiting the country. But what people forget is that over the same period, the Johannesburg Stock Exchange has grown 35%. And that's after the recovery of the COVID blip. So it's easy to have that bias in mind because we're sitting here and we're involved in all the negativity. So sometimes you do just have to take a step back and actually look at what has happened in the markets from a numbers point of view.
Absolutely. So, I mean, the bottom line is it's not all doom and gloom, and there are still really good reasons to invest in a retirement annuity or in pension funds or provident funds. So let's tie that back into the retirement planning. What does it all mean?
Yeah, so Craig did mention it already in terms of Reg 28. We've come a long way since the financial crisis with the regulations. We've kind of moved away from those insurance-based retirement annuities, a lot more people investing in unit trust-based RAs. And like Craig mentioned, most RAs have a 55-45% offshore local split. Yes, we hear such negativity around interest rates, but what people don't realize is that the multi-managers or asset managers are taking advantage of that and have big exposure to local bonds, which, given interest rates, are giving good real returns. So when you factor in the tax efficiencies and the fact that, looking objectively at local and offshore markets, that it's not a case of one versus the other, it's a combination of both and they'll work at different times. A retirement annuity is still a great place to store your wealth for retirement.
So following on from that, Craig, there's a lot of criticism that if you leave your money in your retirement annuity or in your pension fund, you're still going to end up paying tax later on when you're drawing down from your living annuity, and that a living annuity can create liquidity issues in your retirement years. What do you say to your clients? How do you address this issue?
Yeah. When one looks at the numbers, one needs to understand that tax payable immediately is a lot more onerous than deferring tax to be paid at a later date. So that's the one aspect that one needs to consider. Because once you've paid the tax, you're not earning a return on the money that's gone to SARS. And that's probably the biggest disadvantage to cashing in a retirement fund. So the example we ran, we took a 15 million provident fund and we assumed that the person wanted to cash the entire amount in, pay the tax on it, and invest the proceeds. So that would result in them having a pot of money that from age 65 for a period of 30 years could provide an income of roughly 50,000 Rand per month. That's just raw numbers, very base case. Should they, however, have made a different decision, that being to buy a living annuity with the proceeds and draw an income from the living annuity, and the income lasts the exact same amount of time, i.e. 30 years, we found that you could draw up to 12,000 Rand more per month for a 30-year period. So it's about a 25% improvement on the income that you would receive as a retiree. And then you do the back calculation, you go, how's this possible? Because the average tax rate of the drawing, if you go in a living annuity, the average tax that the client pays on that type of income is actually only 29%. And it's deferred, it's 29% being paid at a much later date, rather than an average tax rate, if you drew the whole amount, of around 33% up front. So don't be confused by the jargon out there and the doomsdayers to go and think, oh, let me cash in. Another point I want to make as well is that when you're in a living annuity, the day you decide to go into a living annuity, Regulation 28 doesn't apply. In other words, you can have 100% offshore exposure. So the argument of not being invested in South Africa is a moot point, because once you're 55, if that is your biggest concern, then rather retire from the RA, go into a living annuity, have 100% offshore exposure, but don't go and cash it in, pay a whole lot of tax to get yourself offshore. It's just you committing suicide, financial suicide.
So, I mean, I think what I'm hearing is also keep control of your emotions, not listen to the doom and gloom, be realistic. And also that tax planning, it's not about being tax efficient in the moment, it's about being tax efficient over your lifetime.
The decision clients need to make is to make sure they're not making a knee-jerk reaction to what's happening around them in the world. And that's the importance of a financial advisor. It's not to tell someone what's right or what's wrong. It's to hold up a mirror to the decisions that they're going to make so they understand the consequences. So yes, it's looking at what the tax effect will be today on your decision, but what that's going to do to your plan later on. And as long as clients can just make informed decisions, then we as financial advisors are doing our job.